Ladies and gentlemen, things are looking pretty good for Bitcoin right now on a macro scale. Descending channel formation, extensive consolidation, yes, but that's pretty necessary, that's pretty expected as per what we saw at the start of last year. We saw a massive uptick last year, very, very strong moves going into the start of this year as well. It makes sense to see such extensive consolidation to get us back on track to where we're actually meant to be in the 4-year cycle. For example, I mean, we broke all-time highs before the halving. We've never done that before. So we moved upwards way too fast, way too quickly. Now we're consolidating. We're consolidating in a pretty bullish structure, right? A descending channel formation. There's nothing really too concerning about this inherently. We saw, in my view, what was a pretty solid weekly candle close over the last week as well, testing the center line of a channel, bouncing off that bull market support band. Yes, we're still under pressure. No, we're not in the clear yet, but we can't really complain too much about the structure right now. The big question for Bitcoin really is this, right? Because right now we're reconnecting to the 4-year cycle. We're kind of where we need to be cyclically speaking. The only thing that can ruin this for Bitcoin at this point is the global economy and traditional markets. And so the big question is, will Bitcoin see a bloody recession, right? Not Bitcoin, but traditional markets in general, and hence Bitcoin, because they're all connected, okay? If traditional markets crash, if there is a recession globally, Bitcoin's not getting out unscathed. I know people like to think that it might, but it's just simply not true. I mean, the fact of the matter is Bitcoin does not act independently. Unfortunately, Bitcoin is very much tied to the same things that traditional markets are tied to. So it's very important to note. Traditional markets are here. Look at my hands. Traditional markets are here. Bitcoin is here. And they're both connected to the same thing, which is what drives both of them, right? They're not connected to each other. So Bitcoin doesn't go down because the S&P goes down. And the S&P doesn't go down because Bitcoin goes down. They both go down because something happens in the thing that drives their price action, right? They're underpinned to the same driver of price action, right? People having a good financial situation, the cost of debt being low, these things, money printing, new money coming into the economy, all these things affect both the assets. So the big question for Bitcoin is basically, will we see a regular 4-year cycle? Will everything go as planned with, the 4-year cycle, the 18.6-year real estate economic cycle, and the election cycle, and hence, we'd see a top in late 2025? Or will a unexpected recession destroy all of those trends and drag everything down? Right? That's the bull case and the bear case right now. The bull case is everything that has been happening for the last couple of decades, essentially, right? And even further back in the case of 18.6-year real estate economic cycle, the bull case is all the cyclical trends will remain and we'll see a regular market top next year. And the bear case is all of those trends are screwed and there's secretly a recession brewing right now and it's going to come and it's going to destroy everything. We're going to see an entirely new market environment starting next year. Right, so that gives you an idea of what the bull and bear case is right now. Now, obviously, I'm a believer in the trend is your friend until it ends. So I'm more inclined to believe in the bull case until proven otherwise. But some people are more pessimistic. Some people have different trading styles. I would say that's a pretty idiotic trading style. If we're talking about trends that have been around for decades, you probably want to wait to see them break. But I suppose the question I'm asking now is, well, not if they're broken or not, because they're not. They're still very much intact. And right now we are still macro bullish. But the question is, what are the chances that they do break? And how would we know when they are broken if they do break? Because we need to know how to react to the situation regardless of the likelihood of it occurring. So I think that's a pretty good rundown of what we're going to be talking about in this video. And that was a very long introduction, and the video actually won't be that long. So before we get into the actual content, I just want to mention a few things here. First thing is the Bitcoin exchange. Now, this is the exchange I advertise on this YouTube channel. I give you a 15% trading fee discount with my referral link down below. It takes 30 seconds to sign up. You just click on that link and sign up. 15% trading fee discount, as well as up to $5,500 in rewards for signing up with that link. And you get access, after signing up with my link, to an exchange that has hundreds of trading pairs, that's never been hacked before, that has publicly viewable one-to-one reserves, that, what else? Global non-KYC, you can access it from any country in the world, a very good exchange all around, so use my link down below, and I'll leave the rest of the stuff for the end of the video. Let's get into it. Right, so Bitcoin's reconnected over the last 7 months to the 4-year cycle. It's basically where it needs to be. We are right now on track for regular cyclical price action. And the question is there a chance that that gets ruined by a recession? Well, how would we know if a recession was to occur? Okay, well, a lot of people look at unemployment. And this is probably one of the biggest threats right now. There's another thing people look at, and that is basically the S&P 500 overlaid with interest rates. As we know, interest rates have started dropping recently. In fact, last month, the Federal Reserve cut interest rates by 50 basis points. In my view, that was a good thing for them to do. In my view, that is bullish for assets. But we'll discuss both of these things now because there are bearish scenarios surrounding both of these things. Just to clarify, just because I'm macro bullish doesn't mean you should jump into positions right now. Doesn't mean I think you should be buying Bitcoin, selling the house, selling the kids and jumping in. No, I don't believe that at all. I'm a believer in confirmation. And until we see upside confirmation, I'm very much taking a sideline approach to the market right now while understanding that it is a macro bullish structure and hence being macro bullish. You can be macro bullish without wanting to buy everything you can. That's just simply a straw man, right? So let's get into it. So some people look at the S&P 500, which is the blue line right here, and they look at the interest rate charts layered on top of it, which is the red line right here. And they analyze the chart and they think, okay, when interest rates dropped in 2001, okay, we saw the S&P 500 collapse. We saw a recession in the global economy, right? And the same thing happened in 2008. They see interest rates dropping here in 2008, interest rates dropping here in 2000, led to a collapse, led to a global recession, and obviously led to assets massively decreasing in value. Now they look at the situation we're in right now. We're in a bull market, interest rates have started coming down, and the bears will look at this and think, well, look, in 2008 and 2000, this occurred and it led to the market crashing and it led to everything getting destroyed. Surely that's going to happen again. That's the bearish case right now for the S&P 500. That, in my view, does not make sense. And we can talk about, the circumstances are different this time. We can talk about, they cut rates because of the recession, not cutting rates leading to a recession. We can talk about all these different things. But the fundamental reality is that two data points, 1, 2, right, does not make an established macro trend. You cannot look at two data points, one from 2000 and one from 2008, where the interest rates going down potentially led to a recession, and say that's going to happen every single time now. It's just not a mathematical trend. You need 3 data points to develop a mathematical trend, and we can support this further by looking at the times prior to 2000, seeing that, look, we cut rates over here, it did not lead to recession. We cut rates over here, did not lead to recession. One over here as well, no recession, no recession. And we can even look at the most recent data point, right, at 2019 and see when interest rates were cut in 2019, it did not lead to a recession. Now, some people would say, well, the COVID drop was some sort of a recession, right? But no, it wasn't. It was a black swan event. And when they cut rates in June 2019, there was no expectation of COVID occurring. Therefore, the interest rates drop and the COVID drop was not connected in any way, shape, or form. So that, in my view, is an obsolete argument. There was no argument you can make, in my opinion, where you can say, oh, interest rates dropping is going to lead to a recession. It just does not make sense. It's not a mathematical trend. It does not exist in any trend format. Another reason why it doesn't make sense is because right now we are seeing a unique market environment. We've never, ever, ever seen the Federal Reserve raise interest rates while the market is going downwards. We saw that occur in 2022. We've never seen that before. It's a completely new market environment. Even if there was a trend there, it wouldn't apply to right now due to that new market environment. But there's no trend there to begin with. So I can't see any reason for a recession while looking at interest rates overlaid with the S&P 500. Doesn't make sense to me personally. The one argument I can see that kind of makes sense for us to see some sort of recession is the unemployment argument, right? This is the one that holds validity, that makes some sort of sense, okay? So people look at the unemployment chart and what they do is that, let me go ahead and overlay the S&P 500. They see unemployment in blue and they notice that generally speaking, when unemployment rounds out, it spikes to the upside. So rounding out, spiking to the upside, rounding out, spiking to the upside. Over and over again, it rounds out and spikes upwards. And 8 out of the last 11 occasions where unemployment has spiked to the upside, we have seen major negative price action on traditional markets. So this argument does make sense, right? Unemployment currently is rounding out. Most of the time, it spikes to the upside after rounding out. And 8 out of the last 11 times that's occurred, it has led to a recession. Now, the important point to notice here is that I said 8 out of the last 11 times. So it hasn't got a 100% accuracy rate. It's about basically 75% of the time we see unemployment rounding out and spiking to the upside, a recession occurs with it. It's not 100% guaranteed. It didn't happen, for example, in 2020. There's more, it didn't happen over here in 1989. There's occasions I can point to where it did not occur. So it's not a guaranteed thing, but that actually is a genuine concern. However, again, it's not guaranteed, and one genuine concern does not overrule or does not negate all of the data we have, cyclically speaking, telling us that Bitcoin and the S&P 500 are on track for a regular cyclical top, right? So this is what I'm going into here. I think personally, the argument that, we're going to see a recession right now, we're going to see a recession, it's going to drag everything down, the cycle's gone, everything's wrecked. I think that argument is based on a very, very small amount of actual data, right? Yes, you can point to unemployment. Yes, unemployment is the most valid piece of data there. But even unemployment right now is not confirmed to spike to the upside. In fact, at the last 2 unemployment readings, we've seen unemployment go downwards. We've seen that little dip there, which, puts a spanner in the works for the bears. Maybe it's not actually rounding out. Maybe this rounding out is different to the last times. Maybe it will flatten out here. But even if it does spike to the upside, you've still got about a 25 to 30% chance that we will avoid a recession based on the historical data. And given the fact that the cycles are still intact as well, it just throws a lot of spanners in the works there. There's a lot of mental gymnastics you have to do to be confident in a recession occurring here, in my personal view. So I don't think a recession is guaranteed at all. Is it possible? Yes, it's certainly possible. But here's my main point. Regardless of any of this, it goes back to what I said at the start of the video. Regardless of what you think about a recession, regardless if you think it's likely, certain, doesn't matter what you think. The reality is, in trading, in investing, you should not be making macro decisions without macro data. Right now, Bitcoin is in a macro channel formation. This channel formation has lasted 7.5 months, over 200 days, right? And we will not make a macro decision in this macro channel formation until macro breaks up or down. So the reality is, until Bitcoin breaks this channel to the upside or the downside, you should not really be changing your bias too massively because nothing has actually shifted on the macro. So wait for macro price action to make macro decisions. I guarantee you, if Bitcoin does end up breaking this channel to the downside, that would very likely coincide with unemployment spiking to the upside. That would very likely coincide with a recession because the only way we'd ever do that is if the cycle breaks. So that's why people say the trend is your friend until it ends. You can speculate all you want about whether a trend's going to end or hold within a range, but the reality is you'll never be certain or confident even in what your thoughts are or your predictions are until the range actually breaks. So right now the trend is active, and therefore I would say act as though the trend is going to remain active until it does not, until it actually does break, if it does break. Now, as I said, I don't believe you should be making macro decisions based on macro price action. That includes buying. I'm not saying jump all into Bitcoin positions here. That's irrational. I wouldn't be doing that. I'm personally not doing that. I'm waiting for breakouts, especially when it comes to altcoins. And you look at something like the DXY as well, and the DXY is very clearly warning us that it's not really the time to be buying. Even though I am macro bullish, even though I do believe the trend is your friend until it ends, you can be reasonable within those parameters. And you can look at the DXY and you can notice that the DXY is reverse correlated to Bitcoin. You can notice that when the DXY is in a bear market, for example, here in 2017 and here in 2021, Bitcoin was in a bull market. And when the DXY is in a bull market, okay, here and here, Bitcoin was in a bear market. You can notice that reverse correlation, and hence you can recognize that if the DXY bounces, that's bad for Bitcoin. You can recognize that the DXY is on major support here, stemming backwards from 2015, and you can hence conclude and deduct that until the DXY breaks down, right, and until Bitcoin breaks upwards, you really shouldn't be too heavily invested in these markets. Even though you have that macro bullish bias, even though you can believe in the cycle until it breaks, if it breaks, it doesn't mean you need to be holding all these assets and risking your entire bloody mortgage on everything, right? That's just illogical. It's just a stupid thing to do. Wait for confirmation. But to conclude, to wrap up, I'm sorry for the choppy delivery. Potentially it was choppy, I'm not sure. I try to get these videos out in one take where possible. But to wrap up, basically, a recession is on the table. It is possible, okay? But it's not guaranteed. And in my view, the Federal Reserve going ahead and trusting the bond market and cutting interest rates by 50 basis points was a very good thing in the last month, right? And along with that, we've seen unemployment spike down again, which is good to see, or correct down again, which is good to see. it's less likely in my view than it was 2 months ago. It's still on the table, but regardless of what happens here, regardless if you think it's likely or not likely, at the end of the day, macro decisions come by macro price action. The cycle's still intact, and until there's actual direct evidence that it's broken, you really shouldn't be changing your strategies too much at all. That's my view. Let me know what you guys think in the comments down below. I appreciate you watching the video. Go ahead, as I said before, check out the Bitcoin exchange. My referral link is down below. If you want that 15% trading fee discount, if you want that 5,500 USDT in rewards or up to it by signing up, just use my link down below and get on that great exchange there. Another thing I'll mention is the VIP group on Telegram. We actually just released our Q3 trading results on VIP, 78.32% win rate on my trading signals on Telegram. Exceptionally good stuff there. So check it out if you're interested. It's all there on Telegram. You get a group chat access and you get access to those trading signals. And the last thing I'll mention, guys, is the Crypto Academy's Become a Trader 10 unit course. If you want to learn how to trade, this is where you can do it. 10 units of content, 30 hours, 20 hours of content, depends how fast you are going through it, going all the way from, how does a financial market work, to market patterns, to technical indicators, to candlesticks, market psychology, everything you need to know. And it's on sale right now just to top that off. So good stuff there all around. Check it out if you're interested. Thanks for watching, guys. Hope you enjoyed, and I'll catch you in the next video. Cheers.